Hi, my name is Rod Caldwell, and in this video we're going to talk about account classification. What we learned about last time was a concept called debits and credits, and the fact that all businesses are made up of a series of transactions and that all transactions have two equal sides. When we put that all together, what we came up with is the fact that what we receive is called a debit and is recorded on the left hand side of something called a ledger. What we give is called a credit and is recorded on the right hand side of this thing called a ledger. What we're going to do today is to explore more about ledgers and how they're created. But first of all, what we're going to do is we're going to look at what sort of business structure should I have. It may seem a bit strange to be looking at that first when we're talking about account classification, but really this is the start of the whole accounting, or what we really should call bookkeeping process. We haven't really discussed accounting as yet. So when you first start out, you start out as what I call a sole trader or a sole proprietor. That's just you. And you're out there selling your services, mowing lawns, being an accountant, whatever. But as your business starts to grow, then you look for ways, usually for tax minimization. And the best way to do that is to share your income with your spouse or your partner. So in a partnership, most partnerships are husband and wife partnerships. And they're there purely as a tax measure. And they're the most simplest and easiest tax effective measure you can have. Once you start to grow a little bit beyond that, start to employ staff and so forth, then you really should think about a private company. Now, a private company is something which is created under the laws of the country you're in, so they're all completely different. But the big difference between a sole trader and a partnership and a private company is that a sole trader and partnership at law is you. You are the sole trader, you are the partner in the partnership, you are wholly responsible for that business. In accounting though, we have a convention and it says that you and your business are two completely separate entities right from the go. So no matter if you're a sole trader, partnership or a private company, you and your business are two separate entities, which is different to what law is. At law, it is only the private company which is a separate entity. Now, having covered that, the next thing we need to look at is how to actually start the business. Well, from a financial accounting perspective, and remember, I'm not talking about taxation or law here, I'm not talking about the legal ramifications or the tax ramifications. Each of those are different in every country. But what I'm talking about here is how do you do it for accounting or for bookkeeping purposes? And that's quite simple. Go and open yourself a bank account in the name of your business. And the important part of that bank account is that that bank account is the business as far as bookkeeping is concerned. All income must be, business income that is, must be deposited into that account. All expenses must be paid out of that account. Under no circumstances should there ever be any private monies going into or out of that business account. It's purely for business purposes, and under no circumstances should you ever attempt to pay business expenses out of your private funds. Now, one word of caution here, I'm talking in terms of bookkeeping. In accounting, all of these absolutes that I'm talking about here tend to go a little bit more grey, but that's for another video. So, okay, we've talked about how to start your business from a financial accounting or a bookkeeping perspective and the type of business structures you can go through. Now, let's talk about that thing called a chart of accounts. And really, a chart of accounts is no more than an index to all of your income and expense items. And as you can see there, the index says number 1 are assets, number 2 liabilities, etc., etc. Now we're going to go all the way through all of these classifications and just say what each one of them are, or explain what each one of them is. So, how did we come up with this? Well, it's not anything which is fixed in concrete. You can have any account classification you like. But way back in the 1930s, the New York Hotels Association decided it would be nice if all the hotels had the same sort of a classification. And they came up with this classification: 1 for assets, 2 for liabilities. Now that could be 100 series are all assets, 200 series liabilities, like 210 could be your bank loan or something like that. 300 for, or as you'll see, I'm using it here, 1 dash and then 4 numbers are for all the assets, 2 dash and all 4 numbers for liabilities, and so forth. So really, providing it's number 1 in the beginning, their assets, number 2 is liabilities, you're using this sort of pretty much a standard chart of accounts, which is what most small computerized accounting programs use. So this is what you'll more than likely find in your accounting program. Okay, let's first of all have a look at the difference between an asset and an expense. Asset and expense seems strange. Well, not really. You go out and you buy something. And the question is, what are you buying? Now, if you're buying something which has a lasting value, it's going to be there for a long time, like a truck, for instance, or a computer system, or any number of things. If you buy something which is going to be of lasting value to your business and is going to be used in the business to generate income, then that's an asset. But if you're buying something which is of limited life, less than 12 months, shall we say, then it's an expense. For instance, petrol, insurance, rego, rent, wages, they go on forever. So the difference between an asset and an expense is how long is it going to hang around in the business. And if it's going to be there for quite a while earning money, use your truck to earn business income, then it's an asset. But if it's going to be consumed within a reasonably short period, certainly less than 12 months, then it's an expense. Things such as motor vehicles and computers would be an asset because they have lasting value, whereas things such as staff wages, rent, any of the motor vehicle expenses, they'll all be expenses as such. And the item you acquire, that is the motor vehicle itself, the petrol in the tank, staff wages, which is actually you're buying the staff time, office rent, you're buying the right to occupy a premise. This is what you're buying, this is what you're receiving, and what you're receiving is the debit. The other side of an asset or expense, of course, is the money going out. It can be in sometimes an obligation, but let's leave that for future. So let's just talk about, so the money going out would be a credit. So the credit would go to your cash at bank account, and the debit would go to the ledger account that is related to the item you're acquiring. So here we have one here. We're buying ourselves a motor vehicle. It's a Chevy truck for $25,000. So we're receiving the Chevy truck, $25,000 debit, and we're paying for it straight out of our cash account. Therefore, $25,000 credit to the cash at bank account. It's as simple as that. This one is a purchase on credit. So they can be cash or can be credit. And the credit is sort of thing, you go to the bank and you say, could I have a bank loan please, I want to buy a Chevy truck. And they say, certainly, no worries at all. So you go and buy the Chevy truck, you go to the bank, they make out a check to Chevy Motors Limited, and then they ask you to sign that dreaded piece of paper called a bank loan. So what you end up with is the business loan to the bank and the vehicle. So you have a credit to the business loan, you've got a debit to your motor vehicle as in the other example, and then you have a credit to the business loan because you owe them money. So that's going to be an outlay coming out of your business. What we can do though is have an expense item. So the other side of it is the asset, which was the business, which is the truck, and this one is the expense. But it's exactly the same. As you can see, look, it's exactly the same. You've got motor vehicle expenses is a debit for what you received, which was the petrol. It could be insurance, it could be rego, it could be anything. And there's a cash at bank. You've got a credit into the cash at bank account for that expense item. Now, what we need to talk about are liabilities Now we all have a liability, and it's called a mortgage, from the mortar, meaning death, and we all know that mortgages can be death. But in a business, you don't normally have a mortgage, which is a lien over property. What you normally have are business loans of various sorts, which can also entail a lien over certain business assets. But you also have something which is a liability to your supplier. That is, if you're buying things on credit for resale at a profit to be paid for later, then you owe your supplier for those that stock in trade, and that becomes a liability to your supplier. So that's just examples of liabilities. They're things which we have to pay for sometime in the future, like a business loan or our suppliers. So next, let's have a look at owner's equity. This is a bit of a strange concept unless you've been in business before, but owner's equity is the amount of money you're going to put into the business. Now remember what I said very first up, that as a sole proprietor, the first thing you do to open a business is to open a business bank account. Well, it's no good just opening a bank account that's got any money in it. So let us put some money in. In goes 10 grand, right? $10,000 straight into your bank account. But remember, businesses are all about transactions. They're two equal sides. Now, that bank account is your business, so you have given your business $10,000. Okay, well, there's no other side to that, is there, surely? Well, yes, there is, because that is your business, it's not you. Your personal accounts, they're all stuck away somewhere. This is a business account. You put in $10,000, and therefore that business now owes you $10,000. That's like investing in anything else. You've invested $10,000 in your business now owes you $10,000, and that's called owner's equity. That's called the capital account. Capital account. So under owner's equity, that number 3, we have 3 different account types. An capital account is what holds that initial contribution. Now, you're not going to be in business and not take out something. You have to take something out on a weekly basis, but you cannot at law pay yourself, because remember, legally this bank account is just your money. You can do what you damn well like with it legally, but accounting wise no, you can't. The business monies, you don't touch them. But what you can do is draw in anticipation of profit from the business, and that's called a drawings account. So let's have a look here. What we've done is we've debited something called a drawings account, and we've credited our old friend the cash at bank account. So what we're doing is we're taking money out of the bank, but it is not our capital. Our capital remains there, the business. Our capital is what the business owes us, 10 grand. Right? What we're pulling from our bank account is what we refer to as drawings in anticipation of business profits. And what happens if at the end of the day we don't actually take out all of the profits? Well, those are called retained earnings. And what happens is at the end of the accounting period, which is usually 12 months, the accountants, using accounting concepts, not bookkeeping concepts we talk about here, will determine what your profit is, and they will put that profit first of all against your drawings, and anything left over they put into what is called retained earnings. And it is these retained earnings which you use to build your business. And those 3 accounts, the capital, which is owed to you, the drawings, which you've already taken out, and the retained earnings, which are owed to you, add them all together, and that's the amount that the business actually owes you. Now, the next one we go on to after that is sales. And sales is it's an account that holds the value of the goods that you have sold. Now, when you sell something, you actually give it away. You give it to your customer, and what your customer gives you is cash. Now the cash goes into the bank, straight into the bank, and that's what you've got. You've received for that transaction money. Beautiful. What have you given? Because there's a transaction has both an in and an out. Well, what you've given over is your trading stock, the shoes in the example from last video. So that is what's gone out, and the value of what's come in, the $1,000 for your daily takings here in this case, and what's come in is $1,000 in daily taking, gone to the cash at bank account. What's gone out, of course, is all the trading stock you've sold, your cans of this and bits of that and bits of bobs, worth $1,000. This particular example here would be a small corner shop where at the end of the day they add up their takings in the till and it's $1,000, and there we are. That's the way you record it. The next one is a little bit different. It's called cost of sales or cost of goods sold. I'm not going to talk very much about this because cost of goods sold is all about your inventory system. And if you remember from last video, you have two different systems. One's your financial accounting system and the other one is your inventory system. And how you determine the cost what the goods that cost you that you've actually sold depends on the way in which you've recorded them under either a periodic purchases account manual system or the perpetual computerized system where they actually go to an asset account called inventory on an item by item basis. So it depends really on how you've accounted for your inventory as to how your cost of sales is determined. And again, unfortunately, that is for a future video. So if we go on a little bit further now, we hit our expenses. Now we've talked about these before because one side it was the asset, the other side was the expense. So an expense is things like petrol, rent, wages, stationery. But remember, this is the value of what you have received. So they're all debits, right? You've received the petrol, you've received the right to occupy somewhere, you've received time from your employees to work for you, plus all the on costs that go with that, like superannuation and so forth. Stationery, you've actually bought stationery, so you've got stationery, by the way, means papers, pens, etc. What you use in your office. Insurance, the insurance here could be professional indemnity or the contents of your business. Light, power and air conditioning, usually electricity is another account for that, but that's what it covers. And then you've got rates, well, land taxes, council rates, that type of thing. It depends on where you are and what they're called. But that's all the types of expenses you have. But there are other items, and I say other because there's two of them. Other income and other expense. These are the things that are just popping up without you really anticipating them, and therefore you haven't included them in the budget. So it's very important that the idea is that the things that appear in your sales account, your cost of sales, and your expenses, all of those are only budgeted items. And the reason for that is you want to compare all of those to your budget on a fairly more monthly or at least quarterly, just to find out how you're going. And you don't want to mix up all the figures with income and expenses that you really didn't anticipate in the original budget process. So you have other income and you also have other expenses. And as you can see here, you've got the disposal of an asset. If it's a profit, it goes into an income. If it's a loss, it comes in here in the expense. Compensations payments, which you have to pay, is an expense. But if you made if someone paid you compensation, it would be an income. And the unforeseen tax refunds or payments, the business taxes, not your private taxes, this is the business portion. These are other income items and other expense items. So it's a little bit of a bucket, I suppose you say, of those things that you never thought about at the beginning. This is the bucket that holds them at the end. Often this is where items that attract capital gains tax will appear, whereas items that are for income tax appear as sales, cost of goods sold, and tax deductions so income and deductions, and that works out your income. Whereas often these items here, although they can and often are income tax items, they are also often capital gains tax items, just to make things a little bit more complex. Okay, now we started off looking at the chart of accounts, and I said I'd go through each and every one of those, and that's a pretty quick overview of what they are. But for those of you who are here in Australia, I do have a book, and this is a bit of a plug, Learn Bookkeeping in 7 Days. And all of what I've talked about here, including also that horrible thing called a GST, is covered in that Learn Bookkeeping in 7 Days. Accounting is the other side of it, I say, which things get a lot more grey. Thank you for that. And the next one, we'll actually talk about ledgers themselves.